Hello everyone, welcome to the 16th video of me learning how to trade using Forex. So in the last video we were working on the Mastering Forex course in the official forex.com. We went through what moves currency prices, and now we're beginning to go through the managing emotions in Forex trading. So yeah, let's get started. Managing emotions in Forex trading. Forex trading can cause emotions to run high, with currency prices on the move 24 hours a day. Keeping stress, fear, greed and more in check is essential to trading successfully. Keeping emotion is key to trade. Let's take a look at some of the negative emotions that may arise over your Forex journey and how to manage them. Stress. The Forex markets can be stressful at times. Currency is often volatile and major market moving events can come thick and fast. If you're experiencing stress, then the first thing to do is try to discover the root cause. It might be that you're allocating too much capital to each position, or that you don't have a proper handle on your risk management. The best way to avoid stress though is to plan in advance as much as possible. So, when experiencing stress, try to discover the root cause. Plan in advance as much as possible. If you have a strategy in place for multiple conditions, then you'll have something to turn to when the markets run hot. We'll cover creating a Forex trading plan in more detail later in this course. Impatience. When experiencing impatience. Currencies move a lot, but chances are you'll spend a lot of time waiting for opportunity to arise, or waiting for the right time to choose to close a position. At these times, impatience can creep in, causing you to leap into or out of trades too early. You can't force trades that don't match your requirements or meet the specific criteria you've set as a condition to buy and sell. Impatience will cause you to compromise the work you've done. One way to remedy impatience is to automate your trading with orders. Set up a strategy with orders, and you don't necessarily have to watch the markets constantly. So, don't force trades which doesn't match your requirements or meets the specific criteria you've set as a condition to buy and sell. Try to automate trading with orders. Fear of missing out. Fear of missing out can occur if you spot an opportunity but miss the timing. You might be too late for an ideal entry, or you might have met your personal risk allowance for the day. Alternatively, it can arise when lots of other traders are jumping into a developing trend. Do you try and ride the wave as it forms, or hold off and do some more research? Again, the trick here is to set out a plan and stick to it. When experiencing fear of missing out, set a plan and stick to it. The best traders stand out because of their discipline. You might have to sit out some of the profitable trade opportunities, but if that means missing some major losses too, then it all works out. because of fear and greed. We've seen how fear and greed can drive forex prices on a macro level. It pays to be aware of the effect they'll have on your positions too. One common mistake among new traders is to let losing positions run out of fear of realizing the loss while closing winning trades too early so they can seize the profit. The negative effect that this can have on your bottom line is clear. For many, stop losses and take profit orders are the answer, as well as closing losing positions automatically so you can't let them run. They act as a reminder of your profit target, dissuading you from closing early. Stop. Could be the answer. Closing losing positions automatically so you can't let them run. Overconfidence. When you hit a rich vein of winning trades, as your strategy works favourably during the current market conditions, overconfidence can rear its head. This can have many negative side effects, but the main one to be aware of is overtrading. There's a reason why many experienced traders describe trading as repetitive. They don't abandon their rules. They approach the market with an unemotional mechanical method session after session, day after day. They treat winning and losing days the same while concentrating on their long-term goals. Trading within your means and your ability level. Develop the utmost trust in yourself and your system before contemplating raising the stakes. Forex trading strategies. I think this is what we've done before as well. Like many other market, you can trade Forex using a number of different styles and strategies. Here we discuss how to choose an FX style that will suit you, plus a few strategies to try out. Choosing a Forex trading style. The main styles of Forex trading are the same as other markets: scalping, day trading, swing trading, position trading. Scalping and day trading. Forex is popular among scalpers and day traders due to the high levels of volatility and liquidity you often find with FX markets. An intense trading strategy can work well on the currency markets, where a high number of traders means new opportunities constantly arising. Most scalpers and day traders will stick to the major pairs, where the liquidity is the highest. Trade in high levels of volatility and liquidity. Often most scalpers stick to major pairs where liquidity is the highest. Swing trading. You don't have to stick to short-term strategies with FX though. Many swing traders like to focus on one or two currency markets. Hunting for medium-term price oscillations they can turn into profitable opportunities. Remember though that Forex trading is leveraged, so you want to watch out for overnight financing costs when swing trading. focus on one or two currency markets. Hunting for medium term price oscillations. Position trading. Position trading is also popular amongst forex traders who take a long-term view on the currency pairs. So, for traders who take a long-term view. For example, if you think that sterling might make a significant gains versus the euro and US dollar over several months, you might go long GBP USD and short EUR GBP over the long term. Go long and short. Like with swing trading though, you'll want to watch out for financing costs. Carry trades. The carry trade is a popular strategy in Forex market for position traders, using interest rates to target long-term returns. The first step is putting together a carry trade is to find a currency that offers high interest rate and another that offers a lower interest rate return. You then sell the low rate currency whilst buying the high rate currency, taking advantage of the difference in rates to make a profit. For example, say the Bank of Canada has set a rate of 1.25%, whilst the ECB has set a rate of 0.00%. So if you sell the Euro Canada CAD, you should in theory profit from the 1.25% difference in rates. Of course, you need to earn enough profit to offset the cost of borrowing EUR. Beware of fluctuations in the EUR CAD exchange rate itself, which could offset any gains from the interest rate differentials. Creating a custom FX strategy with indicators. You don't necessarily need a Forex specific trading strategy. The strategies covered in our strategies and risks and advanced trading strategies courses will almost all work with FX. However, one way of building custom Forex trading plans is by combining multiple technical indicators. This works especially well with trend trading. The combination selected should indicate a trend, confirm a trend, suggest potential entries, tell you whether the market is oversold or overbought, and provide a prompt to exit the market. You can experiment with a 4-indicator strategy by choosing an indicator from each of the 4 main types: trend following, trend confirmation, overbought, oversold, and profit taking. You'll find a range of indicators listed on the Forex.com trading platform. So log into a demo or live account and you can start looking at what might work. Right, okay. Oh. I didn't mean to do that. We're through this one. Creating a Forex trading plan. Our trading plan is especially important for FX traders. It helps guide you when the markets are turbulent and provides a blueprint for success. To finish this course, here are a few tips to help you make a currency trading plan that works. Creating a Forex. Pay attention to trading times. Pay attention to trading. Although Forex trading is a 24/5 business, there are standard peak times of increased activity. there are standard peak times of increased activity. When the London and European markets open, for example, volume intensifies as institutional traders move to Forex markets. Then once the New York sessions opens, Forex trading volume increases again. So, why does it do that? There is a lull between New York markets closing and the Sydney sessions opening. When trading volume reduces, spreads might widen. Markets might be stagnant and the fills you get might not be as precise. You could be in danger of trading noise when the Forex markets have little direction. If your plan isn't working as it should be, it might be because you're trading at the wrong time. Alright, so when markets around the world are open, trading volume intensifies. There will be lulls during between one market closing and another opening. Trading volume could reduce, spreads might widen, markets might be stagnant, you could be in danger of trading noise when the Forex markets have little direction. If ensure you trade at the right time. Use stops and limits. The fast-moving nature of Forex means that stops and limits are hugely recommended for every single trade. As we covered in the Techniques of Successful Traders course, it's often a good idea to outline your maximum risk on any opportunity as part of your plan. Then ensure you use a stop to limit your risk there, as well as the limit at your profit target. You might also want to think about setting a personal circuit breaker, for example, stop you from trading if you reach a daily loss of 5%. Your maximum risk. Any opportunity as part of your plan. then ensure you use a stop to limit your risk there, as well as a limit at your profit target. You might also want to think about setting a personal circuit breaker, for example, stop you from trading if you reach a daily loss of 5%. Personal circuit breaker. Right, okay, so something that just stops you from keep losing or trying to win it back. So, outline your maximum risk energy to get your plan. Use a stop to limit your risk and limit your profit target. Personal circuit breaker could be set so to stop you from overtrade or attempting to win back a big loss. Identify currency pairs to trade. Within your trading plan, you might want to earmark the currency pairs you wish to trade. Mark the currency pairs you wish to trade. The major currency pairs tend to have the tightest and most consistent spreads, partly due to trading volume. Partly due to developing trading methods and strategies built around the majors allows you to concentrate your attention on a few pairs rather than looking to match your technique on a wide range of currency pairs. You can also adjust your economic calendar to isolate medium or high impact news relevant to the major currency pairs exclusively. Currency correlations. As they're traded in pairs, many FX markets are closely correlated, meaning that if one moves, there's a strong likelihood that the other will as well. One of the most referred Forex correlations, for example, exists between EUR/USD and USD/CHF. This is actually a negative correlation. When one pair rises, the other tends to fall and vice versa. Knowing about correlations is useful for managing your risk and capital. After all, if you have several similar positions on closely correlated pairs, then one major move could affect all your trades in the same way. In pairs, are closely if one there's a strong likelihood another will as well. Plan for rollover rates. When trading currencies, you borrow one currency to purchase another. The rollover rate is the interest charged or earned for holding positions overnight. Rollover rates. So, rollover rates is the interest charged or earned for holding positions overnight. A rollover interest fee is calculated based on the current difference between the traded currency's two interest rates. So rollover is equal to, for EUR/USD, if the swap rates were 0.178/1.21 on a long position of 10,000 euros, you would be charged $1.28 to hold the position overnight. If you were to sell EUR/USD for 10,000, you will receive 0.82 overnight. These amounts are then just converted back to you into your base currency. Interest. Readjust your Forex trading plan. During your early months of live Forex trading, you'll encounter various market conditions and events. Your plan might work well for some of them, but not for others. This is why adjusting your plan as you go along is such a good idea. Adjust your plan as you go along. You can learn from your mistakes, build on your success, and ensure that you're always adapting. Many successful traders keep a trading diary to track wins, losses, emotions of the markets each day, or market conditions each day. Keep trading diary. Know the regulations where you trade. Know the regulations. Regulatory bodies determine the leverage and margin you can use to trade the Forex markets. The leverage margins you can use to trade the Forex markets. These rules impact what currency pairs you can buy and sell and the size of the account you manage. Buy and sell and your account size, right? And the size of the account you can manage. Most credible Forex brokers ensure they have regulations in all areas they operate and where their clients are based. Forex.com, for example, works with regulatories in every country we cover. Here are examples of two regulatory bodies and the limits they impose. ESMA, European Securities and Markets Authority, oversees the operation of all trading firms in Europe. All Forex brokers must limit Forex trading leverage to 1 to 30 maximum on major currency pairs and 1 to 20 on minors and exotics. A margin closeout rule exists on every account, standardizing percentage of margin at 50% of the minimum required margin, at which brokers must close out one or more retail clients' open CFDs. FCA, the Financial Conduct Authority, authorizes UK Forex brokers. The FCA demands regulated brokerages keep clients' funds segregated at respected banks and separate from the broker's assets to guarantee additional protection. The FCA limits leverage on currency pairs following ESMA's directive. From mid-2019, the regulatory body reduced trading leverage to a maximum of 30 to 1 on currency pairs. Cool. What moves currency prices? Oh, we're done. Mastering Forex. Very good. So, intermediate. We just done this one, right? Yep, creating Forex. Mastering shares and indices. Yeah, let's go for this one, even though it's not really about Forex, but you know, we'll just work through the list. We can always organize the information at the end into the relevant sections. So, mastering shares and indices. The date is 16th/01/2024. Ways to trade shares. As with any financial market, there are multiple different ways to trade shares. In this lesson, we're going to focus on two: investing and CFD trading. Stock investing. Investing in stocks is one of the most well-known forms of retail trading. When you invest, you're buying a share in a company, as we described in the Introduction to Financial Markets course. If the company increases in value, then your investment will increase in value too. So, when invest, you're buying shares of a company. If the company increases in value, your investment will increase in value too. Stock exchanges only allow permitted personnel to buy and sell shares directly on their order books, so most retail investors use a stockbroker. Stockbrokers charge a commission to buy or sell shares on your behalf. One significant benefit of investing is that you can receive dividends, which enable you to achieve a return from your stock without selling it. What is a dividend? A dividend is a portion of a company's profits that they pay back to shareholders. Portion to the shareholders. Pay back, not give back. Pay back. Many companies will choose to reward investors by paying on a regular dividend, usually monthly, quarterly, or annually. Some may also pay one-off special dividends, often after a period of particularly strong performance. While they're usually paid out of net profits, sometimes you see a business pay a dividend despite a drop in earnings to maintain demand for their stock. How much will you get from a dividend depends on how much shares you own. If you own 500 shares in a company that pays a dividend of 50 pence per share, for instance, you'll receive £250. You could even build a portfolio that only targets return from dividends. Build a portfolio that only targets returns from dividends. Looking for stable blue chips that don't offer much stable blue chips that don't offer much growth but do make steady payments to investors. This is called a dividend strategy. Dividend dates. Stocks tend to follow a set timeline when they pay dividends, from announcing the dividend on the announcement date to paying investors on the payment date. Perhaps the most important day to remember though is the ex-dividend date. X-date. You must invest in the company before the X-date to be eligible for its dividend. Anyone that buys stock after will miss out. Right, okay, so from announcing the dividend on the announcement date to paying investors on the payment date. It's the ex-dividend. You must invest in a company before the ex-dividend date to be eligible for its dividend. And you'll buy stock after will miss out. We'll cover dividends in more detail in the corporate actions lesson. Share CFDs. Share CFDs are a little bit different to buying shares with a stockbroker. As we covered in the How to Trade course, they enable you to speculate on a market's price movements without owning the underlying assets. CFDs are owning. When you open an equity position with a CFD, you're agreeing to exchange the difference in a stock's price from that moment until you close the trade. You do this by trading a set number of contracts. Each contract you buy or sell represents a single share of the underlying market. Buying 500 Apple shares CFDs will give you the same exposure as buying 500 Apple shares. Selling 1,000 Tesco shares CFDs is equivalent to selling 1,000 Tesco shares. Like with investing, you'll pay a commission to execute your trade. Because you don't ever own the stock, you won't be eligible for dividends with CFD. However, you'll be able to access leverage, which can drastically reduce how much you spend to open the position. Dividends. Drastically reduce. How much? CFDs versus investing example. You want to open a long position on 100 Walmart shares when its share price is 130. To do so, you can choose between stock investing and share CFDs. Buying 100 shares at $130 gives you a total position size of $13,000. With investing, you would have to pay the full $13,000 up front. With a leveraged share CFD on your hand, you might only have to pay 20% of your position's full value at the outset. In this case, that means you deposit $2,600 as a margin. Your profit or loss would still be based on the full size of your trade in either case. If Walmart shares increases to 1,400, you would make $10,000. If they drop to 120, you lose 1,000. However, because you only paid 2,600 for the CFD position, your return or loss is magnified. Damn. Wait, so in the last one, when you invest your buy share, CFDs enable you to spec on stocks tend to follow. So, right, okay, how long have we got left? 42 minutes. Yeah, we'll leave it here and save this for the next video. So, how corporate actions affect shares. Right, okay, so let me just save this quickly. Alright, thank you guys for watching this video. I'll see you guys next time in how corporate actions affect shares. Bye!